with the S&P being down just over 4.5% and the Nasdaq and Dow Jones remaining under severe selling pressure, as well as Bitcoin falling nearly 13.5% since the beginning of 2022, it speaks to reason that we haven't had the best of start to the year in the financial markets. Not only this, traders are still weighing in bigger Fed rate hikes, which could come as early as March as the US Treasury yields begin to soar. Now, if you'd watched previous videos, you'd know that the US yields typically are a precursor to a bit of a drain on the equity market as effectively the risk-free rate begins to increase, as it's a very safe return. Not only that, today we have just seen oil hit a 7-year high as tight supply bites, with tensions in the Middle East growing, which are aiding these supply concerns. So the whole point of this video is to give you a little bit of insight, as well as potentially some solace and reassuring knowledge in that you should probably continue to hold the investments you have. Now, that being said, if you are holding incredibly risky assets which you do not think will perform well or cannot stand to see in red for the next 5 years, or even longer on time horizon, you should probably look to sell in order to essentially purchase assets at discounted rates. This is what's known as opportunity cost effectively. There are some fantastic companies at the moment that are selling at a discount of their all-time high or their 52-week high, and your money may well be better parked there. Now, obviously, I'm not a financial advisor, so take that with a pinch of salt, and do not listen to someone on the internet for your financial advice. Please do your research. What I want to show you in this video today, though, is if you are holding assets which you do want to hold for the next 5 to 10 years, or you're in it for the long haul effectively, and you weren't trying to trade or flip a position and swing trade the market, some of you may be thinking, well, if we know there's a crash coming, regardless of magnitude, perhaps it's better for me to sell out now and then look to buy back in a short period of time. On screen now is a piece of research or analysis from JP Morgan. I think it released or got published sometime last year. But it looks at a 20-year period of being invested into the S&P 500. Over this 20-year period, there's roughly 5,000 trading days worth of data. And what it shows is if you miss just the 10 best days out of those 5,000, you'd have less than half as much money. And your annualized performance would be 2.44% over those 20 years, rather than the full 6.06% being fully invested into the S&P 500. If you'd missed 20 of the best days, your annualized performance would be a hair over 0%. Factoring for real terms, if we take out the inflation adjustment over those 20 years, you would have had a negative real rate of return. This just goes to show how powerful it is that time in the market effectively beats timing the market. If there's a 10, 20, 30% crash in your investments, those days of where the market begins to flip and there is a sharp upward trend and you're not in the market because you sold out waiting to buy back in, this is what ends up happening to your annualized performance. Not only that, if we look at the distribution of stock market returns over a time frame, this is some data from Professor Robert Shiller's homepage, but as you can see, on an annual scale, the S&P 500 market returns are essentially random and they follow relatively well a normal distribution. What we can actually see, though, is there is some positive skew, and that is that returns lean towards the right, away from zero. Not only that, we can also see that the mean of this normal distribution, or these annual returns fitted to a normal distribution, are above zero. Now, what this says is statistically, on average, more often than not, returns will be positive and trending towards the positive side over a large period of time. i.e., holding is probably the best approach if you strongly believe in the investments that you've chosen. Not only that, we also have other effects as well, such as the day of the week and month of the week effects. So January is typically a flatline month for a lot of equities markets. And there's also, as I said, the day of the week effect, where you've got particular days in the week where you can statistically say in a specific confidence interval that the returns for those days are significantly higher than other days. Anyway, I hope you enjoyed this video, and if you take anything from it, it's that to not panic, reevaluate your investments, and be confident in what you've purchased. I, for one, will be continuing to buy the way down, especially in some of these blue chip stocks that are at sharp discounts currently. Take it easy, guys. Thanks for watching.